people are coming in, we'll get started here. And I respect for everybody's time. Just want to say thank you so much for coming on in and taking time out of your day to hear some thoughts as far as what we think here, or Petros thinks here on the market. What we're going to do today is we're going to start off with how the first half of the year started and some key takeaways. Definitely a good rough spot here, the first quarter. Touch on that. And Cade's going to talk a little bit about the positive signs that we might be seeing here in the market for the second half of the year. And then Tom's going to share some of the things that we're worried about and watching for as well. Then we're going to wrap up with a quick update on the OBBB tax bill that was recently passed last week, and then just another quick Petros update. So as we're going through, and before I hand it off to Cade, I just want to touch on we're all muted just to avoid the background noise. But if you do have questions, we have some time at the end, and if you do have questions, there's a toolbar if at the top or bottom here, depending on an Apple or Microsoft. Toolbar is a little chat function, and you can ask some questions along the way, and our paraplanner Brianna will be gathering that, and if we have some time to address some of the questions out there. So with all the kind of maintenance items top of mind are covered, we'll hand it over to Cade and start touching on the first half of the year.
Awesome. Thanks, Carl, and thank you everyone for joining today. It was a wild first 6 months for the S&P 500 and the US stock market, and a tale of two quarters really in terms of returns. The first quarter was led by value stocks, who outperformed growth after fear hit the market from Chinese AI competition along with tariff headlines. And as a result, investors took that flight to safety and bought defensive stocks, which led to value outperforming. The second quarter, however, was a complete flip of the script. Growth rebounded and led the S&P 500 to new all-time highs as tariffs were paused, AI continued to show new progress, and sentiment improved heading into the summer. As a result of this volatility, we've experienced some of the largest single-day market returns on record so far this year. April 4th, we had a 6% decline shortly after US tariffs were announced. That's the 19th largest daily loss for the S&P 500. And no more than a couple of days later, on April 9th, a 90-day tariff pause was issued and markets rallied a whopping 9.5% in a day. That was the largest daily gain since 2008 and the third largest since the index launched in 1957. But how did other asset classes perform so far? This table, which is often referred to as a quilt chart, shows the returns in a calendar year for certain areas of the market and usually paints a good picture as to how the year played out. Returns are split out into columns on the top, starting from 2020 going to present day and color-coded by asset class. US large cap growth stocks, shown in green, have been the best performing asset class listed here in 3 separate instances, including 2 straight years, 2023 and 2024. However, that doesn't come without risk, as it was also the worst performer in 2022. But what we find particularly interesting is the outperformance of international stocks as well as gold and other commodities. These two pockets of the market benefited extremely well as a solution to investors' worries over the US economy and the stock market. Foreign investment in the US, which has historically been strong, lost some trust, and a lot of that money was allocated to other countries as a result. Gold really stands out as a hedge against inflation worries and the US dollar overall. The inflation uncertainty from tariff announcements only accelerated that trend as even more investors sought out those physical assets as safe havens. And now I'll hand it over to colleague Spencer to talk a little bit about sector returns in the US stock market this year.
Yeah, so as Cade mentioned, we're going to kind of narrow down to the S&P 500 and analyze the sector performance so far this year. So this chart, same as the last one, it gives us a view of sector performance over the past 5 years. And then this year so far is in the far right column year to date. And so as you look in that far right column, you can notice that the best performers in the first half were communication services, industrials, technology, and financials. Now, if you were with us in the first market outlook at the beginning of the year, one thing we want to note is that two of our top sector picks for this year were industrials and financials, which are currently sitting at the number two and number four best performing sectors so far. Then on the flip side, the worst performing sectors were consumer discretionary, which was mainly driven by Tesla's underperformance, healthcare caused by the United Health Group scare and sell-off, and energy and real estate. And so overall, what we really want to point out is that these growth-oriented sectors are dominating through the first half of this year, even after the tariff scare in April, which is consistent with 2023 and 2024 when we saw strong performance in the overall market. And then almost the exact opposite in 2022 when defensive sectors with value-oriented stocks outperformed in an overall poor performing market. And this type of strength from growth-oriented sectors is something you usually see in a strong bull market.
Thanks, Spencer. And when did this bull market begin exactly? Our definition is October of 2022. If we trace back to that month in this chart here and look at returns since then, while US stocks have managed a very strong 71% return shown in purple, European stocks have actually outperformed American stocks in this period. This had been followed under the radar because the high-flying AI stocks in the US have taken most of the headlines in the last couple of years, which has consequently lost attention to the strength that some international stocks have been showing. In light of this trend, institutional asset managers are starting to take notice of this so far this year by allocating large amounts of capital to international stocks. The next slide shows that allocation, and this is not a common occurrence, especially in the 21st century. As a matter of fact, asset managers are the most underweight the US dollar and US equities in over 20 years since 2005. As a result of this, the dollar index is on pace for its worst year since 1973. This has happened due to concerns on rate cuts, growing fiscal deficits, policy uncertainty, and frankly, better valuations elsewhere. The question to ask is, can this trend really continue? Well, let's rewind back to 2005 and see how those international stocks fared out versus the US. This chart shows those US stocks in purple and international stocks in orange since 2005. You can see that from '05 to about '08, international stocks majorly outperformed in those first couple of years when fund managers were underweight the US dollar. But after the great financial crisis in '08 and '09, US outperformed heavily coming out of that recession as growth stocks and financial stocks and other sectors started to pick up. While conditions are not the same as 2005, it is intriguing to see that international stocks have at least shown the ability to outperform for multiple years at a time. And so clarity on trade deals, inflation data, and Fed policy are going to be pivotal to see if capital flows return to the US in the second half of this year. Speaking of the Fed and the Federal Reserve, there remains ongoing tension between fiscal and monetary policy decisions. In January, we were expecting 3 rate cuts this year, but that's been delayed amidst the administration's immediate shift towards tariffs. This has put the Fed in an interesting spot because of that inflation uncertainty. Markets are still expecting at least two rate cuts by the end of this year, and Fed Chair Powell confirmed that they would have cut rates by now if it weren't for tariffs. Secretary Treasury Scott Bessent expects the Fed to cut rates by September, with the caveat that tariffs keep inflation under control. So we're going to be looking for continued negotiation of trade deals, which would in turn support better clarity for the Fed's outlook and a better case for a rate cut overall. And keep an eye on President Trump shifting his focus to naming a new Fed chair for 2026, as Jerome Powell's term ends in May of next year. With that all being said, and with the first half in the rear view, for the second half of the year, we are still positive, but we want to be mindful of the risks that may become more prevalent, which Tom will cover in a bit. So far this year, we've seen the administration shift the order of operations in what we believed would be their policy focus from inauguration. Initially, we thought deregulation and interest rate cuts would be a priority that'd be addressed immediately, but that was clearly set aside for tariff policy and those ongoing implementations and discussions. Now that tariff deals are starting to be struck, we could see a policy shift towards that deregulation, tax cuts, and rate cuts. With that, areas of the market we like are consistent with our view in January, those being financials, industrials, and small caps. Right now, we're seeing some pretty amazing levels of negative sentiment, yet the stock market keeps going up. This chart is a great signal that visualizes when things often get too far stretched in regards to negative sentiment. A survey is taken on investors asking them where they think the stock market will be in the next few months. And in recent data from the survey, we're seeing extremely high amounts of people who think markets will go down, or what we call bears, relative to the amount of people who think markets will go up, or who we call bulls. And because of this, and the fact that stocks continue rising, people are calling this the most hated rally that the stock market has ever seen. This level of bearishness occurred in 2022 as well, which was followed by a 28% rally in the S&P 500 after reaching maximum bear levels. So looking at this chart, we kind of view this as a contrarian indicator, meaning we would be more inclined to buy stocks when this survey shows more bearishness like it is now. A large reason why we believe a positive second half might occur is due to markets being heavily momentum driven nowadays. And that's caused by a number of factors, including investor psychology, trend following algorithms, and of course, the fear of missing out. One track of momentum is an indicator called the Zweig breadth thrust, or ZBT. This is triggered when essentially a large number of stocks in an index make a large positive move in a 10-day period. This is actually a very rare occurrence and only happens a few times each decade. This table shows the 16 days this has ever happened since 1950. And what's amazing is that when we look forward 6 months in 1 year on the right-hand side there, the S&P 500 has been higher 100% of the time. On April 24th, we got notified of another trigger, and so we are well on our way to being positive 6 months later by October of this year. Moving on to areas of the market that we like. One sector we still lean into heavily is financials. We could see a couple tailwinds that benefit the sector in these last 6 months. One of those being yield curve steepening. This happens when short-term rates, which are heavily influenced by the Federal Reserve, like we've been talking about, drop, while long-term rates remain elevated. we experienced one of the longest inverted yield curves ever between the 2-year Treasury and the 10-year Treasury from 2022 to 24. Given the yield curve is now starting to stabilize, banks have the advantage now to borrow at lower short-term rates and lend out via mortgages, etc., and other loans at higher long-term rates to increase their net interest margin and overall profitability. Demand for credit also remains stable, with healthy lending supporting that top line growth for banks specifically. And then for investment banks, easing financial conditions supports increased transactions in the deal-making space, specifically IPOs and mergers and acquisitions. These transactions occur more often in healthy economic environments and when investor confidence is high. Right now, we have about 180 IPOs that have been brought to market this year, which is on pace to beat 2024's numbers by around 60%. That's just a signal of companies feeling optimistic, comfortable, and confident about raising money and executing on these deals. The second sector we remain constructive on is industrials, which is the second best performing sector year to date. The One Big Beautiful Bill, or OBBB, was recently passed and has some key items that give positive catalysts for capital-intensive companies in this space. First, $150 billion is being allocated to new defense spending, and that often comes in large multi-year contracts that help lock down steady, predictable revenues and cash flow for defense companies. Second, the existing bonus depreciation provisions were extended so businesses can now deduct 100% of the purchase price of equipment and other long-term assets in the year they were purchased. This incentivizes businesses to deploy capital now in order to expand while also reducing taxable income for the year. And then data centers. They're playing an increasingly important role in the demand for digital infrastructure. These massive specialized buildings are going to help support the computing power that AI needs, and fuels growth in industries such as engineering, construction, power systems, and heating and cooling. Lastly, we still like small caps quite a bit for similar reasons as discussed back in January. Their relative valuations versus large caps remain highly imbalanced, and historically, we've seen this to be reverting back to the mean at some point, which would support the case for a price increase in small cap stocks. Any sign of a future interest rate cut, which we believe is still on the horizon, should bode well for small caps since they rely on debt to finance their expansion, and this would make it easier to fund that growth. And then IPO activity, as I mentioned, would also bring investor confidence and attention back to the asset class and away from large caps, and hopefully move that valuation disparity closer to equilibrium. With that all said, I'll pass it over to my colleague Tom to talk about things we should watch out for in the second half of the year.
Thanks, Cade. Yeah, the interest rates is really the big caveat that we're sort of watching here in the second half. A lot of people are thinking the things that could go wrong could be a trade war with other countries, interest rates and the yield curve possibly going higher, and the labor market deterioration, and just in general, higher average volatility in the markets. If you look at the slide here, you can see that 47% of the people polled in this still consider the trade war to be the biggest trigger for a global recession. Then the second two you can see would be a hike in interest rates that would, again, most likely bring the stock market down if rates got into the 5-6% level. We don't take that view right now. We are seeing labor actually look solid, and we don't feel that there's a need right now for the Fed to hike. So we believe that in September you should see is when the Fed meets again that they are betting on the next rate decline. And in this curve, you see that the 2-year yield since January has actually gone down quite a bit from about 4.5, 4.25 down to 3.9. This affects things like money markets. So a year ago, last year, you were seeing money markets push closer to 5%, and now they're starting to break 4%. Again, back what Cade talked about, this is a sign of steepening of the yield curve. Because if you look at the top line, which is the 30-year Treasury rate, it's looked pretty flat since the beginning of January, where it looks to be around 4.8 in the beginning of January, and right now we're hovering around 4.9. Last week we had some conflicting data where interest rates went from about 4.9 to about 4.7 on the 30-year, and then numbers came in to maybe give a little bit of scare to push rates back at 5%. But right now, we feel like that 5% 30-year is kind of, again, a trading pattern, and we're seeing from 4.5 to 5. If we do believe that rates will come down, we think this might be an opportunity where you would want to lock in some maybe 15 to 20-year bonds that you can get between 5.5% if you think that rates will go down next year like we do. The 10-year in the middle there was about 4.4, and that's interesting because that actually affects the mortgage rates. It's not the 30-year, it's the 10-year. And so as that has slowly drifted down, you're seeing the jumbo mortgages and mortgages start going below 7%. If we do feel that 10-year comes down below, that would be great for builder stocks and home purchasing. So we think that could give a little bit of incentivize to the economy as well too. On this one, we just see that the labor market is losing momentum, which again should give some pause for the Fed to lower rates in the second half of the year and definitely the first half of 2026. But in general, the Fed is staying pat right now until they see a little bit more data come in, and it looks like the next meeting will happen in September, and there is a thesis there that we will go down another quarter starting in September, which could give some fuel for the stock market. And here you're seeing the VIX, which is the volatility index. This is the highest spike in April when we saw once the tariffs were put on at 50%, 100%, that the market started selling off down 20%. We haven't seen this type of volatility since COVID. And VIX in general is below 20, and the average VIX right now is about 21, 22. This could be a continuing trend until we have, again, more clarity on where we settle in on tariffs. But as you see, tariffs have been settling more on the 20% range and not the 100, 150% range. And I think, again, that's what's easing a little bit of tension in the stock market. So I think, again, with the Fed is going to wait a little bit to see what happens with the finalizing of some of the tariffs. But as you can see, though, the volatility has come down quite a bit and has made people a little bit more easy to put money back into the stock market. And that's it from here. And I think, Carl, why don't you give up the summary? And I think the big news is the big, beautiful bill, and maybe we can get some clarity on that one.
Yeah, I can't say a big, beautiful bill without laughing. It's hard to take it seriously, the name there. So, but yeah, so just to summarize, still pretty positive here for the second half of the year. If you joined us for our first market outlook, we were anticipating more in the second half of volatility, but we got that a lot sooner than we anticipated. And then reiterate as far as sector bets, primarily focused on financials, industrials, and then a little more contrarian bet here on the small caps. And then Tom did a great job just recapping a lot of the risks that we're looking for in volatility, interest rates, and still haven't quite finalized or solved for those tariffs yet, even though the stock market has recovered there. So just to spend some time here on the one big beautiful bill, the OBBB, when we took a look at it, the first item is that it was essentially a continuation of the Tax and Jobs Act of 2017, because those were set to expire here at the end of the year. The Tax and Jobs Act originally was more helpful for businesses and business owners as far as their investments and additional deductions, and for lower income folks with the doubling of the standard deduction back then. So those two continued. And as far as the new items, when we look through a number of the provisions, the area or type of client that is most helpful for is generally for individuals under $100,000 or $150,000, or married folks under $250,000 a year of income. So a couple of the highlights. So as far as the standard deduction for married filing jointly, the beginning of the year was set for $30,000. It just increased a little bit to $31,500. But the one of the major items here for folks over the age of 65, originally there were some promises around not taxing Social Security. Couldn't quite get that through, and so therefore what they did was they enhanced the senior deduction. So for a married couple, both over age 65, originally you would have an additional standard deduction of $3,200. Now it's actually all the way up to $12,000, but it phases out if your income is over 150. So generally more helpful for the folks under 150, married filing jointly under the 150,000 and age over the age of 65. Excuse me. Another provision that was helpful for folks in Minnesota or others in high tax states is the increase in the SALT tax deduction. That's the state and local income tax. It used to be that you'd be able to deduct your state income tax off of your federal return. Tax and Jobs Act reduced that and limited it to $10,000, but it was just raised to $40,000. And again, if your taxable income is over $500,000, it starts to phase out. So it's primarily for folks under the $500,000 of income that would benefit. Other side information here: the child tax credit expansion went from $2,000 per child up to $2,200 a child. And one of the other interesting things, the last one here, was the charitable deductions available for non-itemizers. So one of the issues that popped up from the Tax and Jobs Act was when that standard deduction doubled, when folks are giving to charities, they wouldn't be able to get a tax benefit for it because the standard deduction was so high already. So they might as well take the higher one. Now, if you're married filing jointly, make under $150,000 a year, you can take the standard deduction plus up to $12,000 a year of charitable gifts. So when you tally up for the tax benefits and where most of the benefits were directed to were married couples or individuals or married couples over the age of 65. When you tally up those standard deductions plus the ability to potentially deduct charitable gifts up to $12,000 a year, you can almost get to about $50,000 or a little bit over of a standard deduction for those individuals. So most of the benefits were directed into that income bracket and to help some of the higher tax states individuals as well. So with that, I got one more slide here for you, just last update. So at the beginning of the year, we announced the launch of Petros Family Tax and a couple of new tools that we had available. The only update I had for you this time is actually coming up here, and we'll be sending some emails out shortly. But the weekend of July 26th is when we're going to have a more integration back with Wells Fargo Bank. So, and there's going to be emails on this, but if you have a wellsfargo.com login on that weekend, we're going to recommend you logging in, and you'll be able to see your Petros Family Wealth accounts, and you'll have to re-sign up for the electronic delivery. If you don't do it that weekend, not a big deal. You can do it anytime, but you might start getting all the statements in the mail. And for folks that do not have a wellsfargo.com login, you'd still log into your normal Trade PMR website that we have, but you'll still need to reset up your electronic delivery. So we're going to be sending an email reminder with some more details a week and a half before and then a couple days before. But just wanted to give you guys a heads up as we chat through. So with that in mind, Bree, I don't know, do you have any particular questions or a couple questions that maybe popped up in the chat that we might be able to help answer, or no worries if not?
No, we don't actually have any in the chat.
Awesome, that sounds good. Well, hope you enjoyed and didn't put you to sleep or anything, but if you have any questions at all as far as our outlook or how you're positioned compared to our outlook, feel free to reach out to your advisor, and happy to chat. And then if you have any questions about the tax law changes, we just started redoing a lot of our projections for our Petros family tax clients, and so far net positive, but happy to chat through as far as any impacts in your situation. So with that in mind, again, appreciate you taking some time, appreciate you all. We don't take your trust and confidence lightly or for granted, and hope to see you soon, hope to talk soon. Thanks so much.